Welcome to After Hours at Traders Post for Friday, September 19th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Traders Post, joined by Peter, Exit Liquidity Hartman, to break down the market madness. After Hours is your go-to live stream focused on macro trends. That's the dollar, equities, and policy for retail traders, brought to you by Traders Post, the best advanced trade execution engine known to man. But more on that later. For now, we turn as ever to the dollar. Peter, the US dollar is everything to me.
Is it? Why?
The US dollar, when it rises and falls, it causes relationships to succeed or fail. It causes losses and successes. It causes money and bankruptcies. So it's very important to pay attention to it. Peter, it's half of every transaction, the currency you're dealing with. And people don't like thinking about that.
You use it as an indicator for your trading, right? If I understand, recently you say you check the dollar to see what's going on. How does this help you?
I always look at the dollar, especially what it's done over the last 12 hours, all the time, whether I'm trading or not, because it lets me know what kind of stress is existing inside the global financial system. Very simple. If the dollar goes up, people need more dollars. If the dollar goes down, people need less dollars. If people need more dollars, they need less of other things, so those things sell off, and vice versa. And so the higher the dollar goes, the less I will take long risk, and the lower the dollar goes, the more I will take long risk.
Okay, so dollar down is bullish, dollar up is bearish.
In general, it is.
Guaranteed.
Now, if you're going to get fancy about it, it's dollar down and what's going on with bonds and what's going on with gold and what's going on with crypto and equities and what's the correlation between everything. But let's just keep it simple for people. All right. This is a simple show.
So how's the dollar?
The dollar has bounced off the low end of its range at around 96.23. We take a look at the DXY futures. These are dollar futures. Why? Because we get to see volume. We don't get to see that specifically on the DXY. And so because we have the volume, we have our different moving averages, we have different levels that we can take a look at. And doesn't it look beautiful here, Peter? Can't you see quite clearly that the dollar bounced right off of its lower range? And it rose back up to the level that it broke just before. Now, here is the interesting thing. The low of this dollar is when the FOMC cut rates by 25 basis points. You would imagine they're cutting rates, they're trying to stimulate the economy, the dollar would go down. In fact, the dollar was down beforehand based on expectation of rates being cut.
Right. So what happened?
Now, the dollar is just one of the types of dollars that exist inside of the United States, right? The currency is just one of the instruments. The dollar is basically a bond. It's a bond with an infinite maturity and no interest rate. So it's like a pretty crappy bond as far as it's highly liquid, but you don't really want to hold on to that. So it's good to look at interest rates of what's going on at the same time. And at the same time, we're seeing that interest rates have been falling, right? In fact, they've been falling for the US here since 2023. Oh, what did that coincide with, 2023? The start of the bull market. The bull market started in crypto in October 2023 and a little bit later on in equities. And would you know it, we are now at all-time highs for the S&P, all-time highs for the NASDAQ, and all-time highs for the Russell 2000, the little itty-bitty ones, the non-magnificent 7 stocks, the ones that people don't really pay attention to. Those guys are up too.
Gold is up.
Gold's up. Well, gold's actually sold off a little bit with the dollar being up over here, but oil has as well. But this usually portends, this means like raging bull market. Okay, so why am I worried? I'm worried because we're seeing bonds from other places in the world. Here we have the Japanese bond, the German bond, the UK bond, and the euro. All of those bond yields are going up. All those bond yields are going up. When bond yields go up, that means people are selling equities. If bond yields go up, that means bond prices are going down. People are selling those bonds. Well, if they're selling the bonds, where is that money going to? Well, part of that money is coming into equities. Money is flowing into equities, S&P, NASDAQ, Russell. as a way of chasing performance or saving your money. We don't know what it is, but it seems to be happening. So that we're having the dollar going up at the same time as equities are making all-time highs is indicating stress within the financial system.
Vic London in the chat says all-time highs because USD value has tanked. USD is worthless, he says. Shots fired.
Well, you always have to compare these dollars versus other things. If you think that the US dollar is worth nothing because it's being printed all the time, fair. But it's not. It's being printed just like all the other currencies, or nearly all the other currencies are. And those currencies are being printed more. There's more Canadian dollars being printed, more euros being printed, more Japanese yen being printed than the US dollar is. So compared to the other ones, it's still strong. I always have that pushback for when people are saying that dollars are garbage, because you go, well, then what's not garbage? What's the money you have in your bank account that you're saving your thing in? If you say
Bitcoin,
crypto,
baby.
fine. Totally understand. Totally
Bitcoin all the way. That's the good stuff.
Exactly. Give me that sweet, sweet Bitcoin in my veins. I get it. But this is something we want to pay attention to. If the dollar stays above, right now we're at resistance. If the dollar stays here at 97.3, turns over and starts to fall, then we are in for dollar down, equities up. That would be the ideal here. If this is a double bottom on the dollar, and now we're about to confirm a bullish move on it, where the dollar moves up not only to the high of 99.6 that it was at before, but blasts off from there, we are in for a year of a bad time.
I don't want to see any blow off dollar. So why do you what is it that you said? Why is it bouncing despite the rate cut?
Because if what's going on is that institutions, sovereign funds, other players are selling their foreign assets to put the money into American assets, they'll also put it into the dollar. So the dollar is going up as equities go up. That could mean that money is fleeing from elsewhere coming here. But that usually means that it's rats leaving a sinking ship. The ship's going down.
Right.
So it's like a temporary thing. It could be chasing performance, but I don't know why you would put it into the dollar if you're chasing performance. You'd put it into equities. Plus, let's move on to our second thing here with equities and crypto. Bitcoin is going down. So we have Bitcoin pulling back here, right? So as Russell, S&P, and NASDAQ are making new highs, Bitcoin is giving up the ghost here. Bitcoin's falling.
Top of the market. Cycle's over.
Well, it makes sense that Bitcoin would be headed towards its some of these levels. The Bitcoin didn't actually move much during the FOMC. In fact, I was very surprised. Bitcoin didn't move at all.
Right.
Bitcoin didn't make any significant move. One of the most highly volatile assets available, and it barely moved an inch. Well, at the same time as that's happening, we have global liquidity, which is, we offset that by 78 days, and we have liquidity peaking here. That's this yellow line down here. And so we're in for potentially a low in liquidity all the way till, let's just pull up the dates here. A low in liquidity until, let's call it November. So we could get a pullback on that. And Bitcoin is highly correlated with global liquidity. Well, depends how you calculate global liquidity, but it is correlated with it. And so the fact that we're having movements up in equities and the dollar, but not in Bitcoin, again, leads me to believe that foreign assets are coming in order to stay in American financial markets, but not wanting to take the risk of the crypto markets. So we'll see how that plays out.
All right. So I think we're going to be talking coming up about the Fed. and the rate cuts and the consequences of that. Just now, you've talked about the dollar and you've talked about Bitcoin. So, relative to those two or those two together, what's the trade?
Well, the trade here is if you're intraday trading and you're focused on equities, especially on the S&P or NASDAQ, I would say continue with your long bias because nothing seems to be stopping this train. If we take a look at today's price action in NASDAQ, if we move to the intraday, we'll see that normally on the intraday, we have a rise in the NASDAQ in the overnight and then a sell off of NASDAQ during the day. Rise of NASDAQ in the overnight, sell off during the day. Rise in the overnight, sell off during the day. Some sort of movement like that. Today, I was expecting doubly that. Let's get a rise and sell off even more because we're going into the weekend. People are going to want to take profits. They don't want to keep the weekend risk, what have you. We went up even more than the overnight. NASDAQ from the lows of the session was up 67 basis points, which is pretty significant of a move. And the idea that it's closing on the highs, it closed on the highs, is suggesting that we're in this bullish trend, as you can see here from the bullish indicator on the chart. And so who knows, maybe we get a sell-off next week or what have you, but people were fine going into the weekend with long risk in futures. So that's pretty interesting. So the trade here, if you're going to be long-term, we talked about intraday, the bias should be towards the upside unless proven otherwise. For long-term, I'd be doing the opposite. I'd be looking for OpX. So by the end of September here, we're in OpX season right now. So that is options expiry, where we have daily, weekly, monthly, and quarterly options expiration all happening within this 2-week period. And so by the end of this month, a bunch of options are going to come off the table. Okay. If you want to get an idea of what's going on with there, right now, a similar event is happening in Bitcoin, where Bitcoin and Ethereum options are expiring. And so you have this potential downside to the market. So if that happens with equities, we can get a pullback on the NASDAQ all the way to 24,159 down here without blinking an eye. Could totally happen. A drop of 3%. Totally in the cards.
What would you have to see in the market to think that was more likely to occur than not? Or what would be the warning signs as that was about to occur? Or would it be a black swan surprise?
No, for me, the expectation would be that we are in the window of weakness headed into OpX. You just have to have that as a possibility because most crashes happen in these windows 4 times a year.
Okay, so window of weakness is just about the calendar date.
Correct.
OpX. Okay, got it.
So when you get that weakness and the options have expired, if any catalyst happens that drives prices to the downside, you get this vicious cycle where people need to protect their positions by rushing for insurance, rushing for options. That causes those options to increase in value, which causes more the market makers to have to hedge their position by selling futures, which causes the price of futures to go down, which causes people to rush to get more options. So you just have this gamma towards the downside, which is what it's called. And so within a flash, with barely any catalyst, you can get a huge sell-off. And we have a walking catalyst as president of the world. Who knows what he'll do? Who knows what he'll tweet out? Who knows what he'll say?
I like that. That sounds like a supervillain's or superhero's name, the Catalyst.
The Catalyst, exactly.
Awesome. Okay, pretty cool. So does that? So Bitcoin, what were you thinking? What's the trade there, or did you express that?
Yeah, so I'd be actually looking for long Bitcoin, right? So once we get past this window of weakness, especially since Bitcoin is selling off, I would be looking for opportunities in order to buy this asset. So when I am in Bitcoin here, let me see if I could pull up my levels. I could show you. So the idea here, you have 2 ideas. One, if you just go by the calendar dates and you go, the bull market in Bitcoin usually lasts 1,064 days. Count from the low to the peak of the Bitcoin cycle. It's 1,064 days. Not 1,059, not 1,072, 1,064. And we can get that ends, if we count from the low that we had last time, ends October 20th. So until then, sort of dubious on Bitcoin. We can get a massive drop. There are unmitigated levels all the way down to 92,000. So if that happened, I wouldn't be surprised, right? And 92,000 on Bitcoin would be a drop of 26%, which happens all the time in Bitcoin, even in a bull market. 33% drawdowns, totally normal. So I would be, if I was buying spot long-term holder, I'd be buying all these 5 to 10% dips in Bitcoin that I think we might get. If we're at the top of the cycle, and that's in October 20th, well, and you're not the kind of person who wants to hold on to a bag, well, sell everything now. Not financial advice, do your own research, but what are you going to do? We're in a period of weakness. If you don't like a drawdown, sell out now. If it's not over, we get past October 20th, or you have the balls and you decide to get in right now, well, then the next serious period of weakness is March, which means we can get a run up all the way into the end of the year, called the Santa Claus rally, get a run up again in the new year as people have fresh sheets, and they can go ahead and buy new assets and use their high performing assets as collateral in order to get more. All the shenanigans that rich people get into in order to buy more stuff with the assets that they have, and we can get like massive run up into March, and then for there, well, watch after hours for details for how far we can go down and how long. That's a little teaser there. It's about 400 days, but who's counting? All right. Now, the most interesting thing that happened this week is, of course, my anniversary. Nope, kidding. Sorry. It's Jerome Powell who came out and cut 25 basis points. Peter, who would have thought a silly old 25 basis point cut would be the source of such controversy? People don't know what to make of it.
It shouldn't be 25. It should be 50. I think that's the controversy. I mean, if you're going to bend the knee to Trump, if you're going to bend the knee to Papa Trump, bend him all the way, bend both knees, get down there. But 25, it's like still living on the edge. The market, do you think the market priced in 50, or do you think the market priced in 25?
25 for sure. By the time that the Fed meeting happened, the futures market had a 96% chance of a 25 basis point cut. And I think the poly market, the beta markets had like a 90%, 80, high 80s, low 90% chance of a 25 basis point cut. So yeah, they did price in that. Trust me, if there was pricing in a 50 basis point cut, we'd see at least 30% or something like that on the.
So you say that
50 basis points. Yeah.
You say that, but I would have expected that even 25 would have a significant impact.
Well, wait, a significant impact in what way?
Well, I thought the market would move way more dramatically when the Fed cut.
It already did. We got all-time highs for like 7 days up until the meeting.
All-time
The market
highs.
is perfectly happy with this.
Yeah, okay.
All-time highs in all assets?
Bitcoin
indexes? Okay, Bitcoin's been... We're in altcoin season now, Peter. So get off your Bitcoin and jump into all the nice little Sui's and Cardanos and Solanas and Ethereums, all right? Put on your big boy pants and go out the risk curve.
Okay, so you said it moved all-time highs. Okay, get it, 25. So is the market happy with 25? Are people happy? Because the controversy was that people thought it should be more.
All-time highs means the market is happy. Let's just put that to rest. The market is happy with 25 basis points.
So where's the controversy?
It's not 25, just 25 basis point. It is 25 basis point with the expectation of more coming down the line. Right. So the big question now is, will we get 25 or 50 in October?
That's the big question. Here we go again. Here we go again. Same question. What does Polymarket think?
Well, before we get to there, I think it might be fun to listen to somebody who was on the inside of the Fed. Don't take my word for it. We're just people on TV. Let's listen to what Daniel DiMartino Booth has to say about, let's hear what you had to say before the meeting happened. This is always fun. Go on back to see what analysts said beforehand. It's all great and all after the thing happens. Let's see what you said before. Can be pretty interesting.
And whenever it's Fed Day, we really appreciate getting opportunity to speak with our next guest, Danielle DiMartino Booth. She's the CEO and Chief Strategist for QI Research here. Danielle, I know you follow this closely with your time at the Dallas Fed. What do you think the Fed should do today, given all the data we've seen over the past several weeks? What do you think they should do?
Well, so I think it's more than just the 911,000 downward revision to the annual benchmark numbers that we saw through the end of March the 31st.
Yeah, just a reminder, jobs were revised down by 900,000, 911,000. So about 51% of all jobs that they thought were there were not there.
Yeah, it's a small correction.
Yeah, a small correction.
Revision. It's a revision. I'm revising
2025.
I'm revising my marriage. I'm getting a completely new wife.
It really is the downward momentum since then that we've seen. Had the Fed had those real-time revisions in hand, then they would have seen that there was justification for lowering rates in May, June, and July, right? We now know that we've had 3 months of construction job losses, et cetera, because it's more so right now the real-time revisions that really, the pandemic notwithstanding, June's job losses were the first since September of 2010.
Right.
So first time in 15 years. These are kind of like bright red flags. Yeah. So it's pretty obvious.
So there's usually not any job losses in June. Since 2010, there haven't been a June with job losses. Now there is. And that's after almost 1 million jobs being revised away. So she's like, well, if the Fed had these numbers in hand, obviously we would have cut in May, June, July, which they didn't do.
Well, okay, I don't get this. Obviously, every time I've been hearing about this, Jerome Powell said it's because of the unknown with the tariffs. So how can we say that had they known this back then, they would have? The tariff situation was even more unknown.
No, the idea here is that if they're cutting 25 basis points now, right? If the idea is that they're cut 25 basis points now with that information, the tariff stuff is still the same.
Is it?
Right? Yeah, of course. They still are saying they're expecting inflationary effects because of the tariffs. They're still saying that. Okay. So if they're saying that now, which is what they were saying back in March and April, and she's saying, well, if those jobs, they knew they weren't going to be there. If they're cutting now 25 basis points, then they would have cut then 25 basis points. And if they would have cut then 25 basis points and they haven't done it, well, then you got to cut 50 now.
Look, Tom, hindsight's 2020. That's no reason to hit the gas prematurely. We got to be responsible. I like Jerome Powell because he's being responsible. He's showing that he's in no haste. He's in no hurry in order to do anything. I don't know how much he gets paid, but it's not enough. And probably too much at the same time.
That the easing cycle should have begun early this summer. And so that's why there's so much in the way of rumblings about will there be a triple descent today between Myron being there for the first time, Bowman and Waller. You know, by the same token, you got
triple descent is they'll make their decision, but will there be board members who dissent and say, I wanted something different, even though the decision is this? I wanted there to be further cuts or whatever it is. So this is before the meeting.
This is before the meeting. So when was this? What date was this? This is...
Well, this only came up a day now, but it showed up. This is on Tuesday this week.
Okay. All right.
At the St. Louis, Kansas City duet, will we see Alberto Musalem? Will we see Jeffrey Schmid? Will we see them dissent in favor of no cut?
Really?
Well, I mean, the more hawkish and uncertain you are about eventual and ultimate pass-through of tariffs into consumer prices, the more hawkish you're going to be. And one can only imagine at a higher level how very awkward and uncomfortable it is around that gigantic wooden oval table today in the Eccles building.
Yeah, talk about awkward meetings, right? This is going to be one of the strangest I think we've seen in quite some time. But Daniela, I just want to jump off what you're talking about in terms of cracks in the job market, because a number that I think is a pretty good current number to look at is unemployment claims, right? And they're the highest they've been in a long time. But at the same time, you know, inflation at 2.9% is moving further away from the Fed's 2% target. So, you know, what's the Fed to do when stagflation is on the horizon?
And that's a great question, but I'm not so sure that it's stagflation necessarily for the consumer because of what we saw in terms of margin squeeze that was very apparent in the producer price index, and the fact that whether it's Walmart or Target, they're telling us we're having to discount furniture. We're having to discount discretionary goods. We cannot get our customers to buy discretionary goods. Bloomberg did a great job of covering Moody's, showing that now 50% of all consumption in the United States is attributable to the top 10%. That other 90%, they cannot afford higher prices because they're already forking out so much for what we call essentials.
Isn't that terrifying? All right, recap here what she's saying. On one end, you have the idea, so the host was saying, well, what about stagflation? What's the Fed supposed to do? Inflation's not moving exactly in the direction that they wanted to, and jobs are being lost. So this is usually the classic formula for stagflation. And Daniela is saying, hey, not exactly stagflation, because usually stagflation has the same consumer who lost their job has to pay higher prices. But what we saw in the PPI is that the producers aren't passing the inflationary prices down to the consumer in aggregate, net, because they know the consumer can't afford it. So they're taking margin squeezes, which means that their profit is getting smaller and smaller, which is bad for that. It's one thing for the person to lose their job, it's another thing for the business to go out of business. So the margins are getting compressed. It also makes it less likely that new entrants will come into the market, all kinds of stuff like that. So growth gets sidelined. And she's saying the bulk of the purchases, the bulk of the consumer spending in disposable, so discretionary spending, things you don't have to pay, you don't have to buy, is being done by the top 10% of the economy. So the top 10% is driving most of the spending. And and the producers have to make sure they don't put too much cost on the consumer. So she goes, this is almost worse than stagflation. It's stagflation where the price increases can't be passed along.
All right. So I want to, how much more do we want to hear about the past? I want to hear about what.
I do want to finish this. It is worthwhile to hear what she says here, because we then talk about 50 basis point, I believe, coming up in a second.
All right. And we have in the chat here, Kevin Farms, he's saying, U.S. Federal Reserve Governor Stephen Miron was the only person to advocate for a 50 basis point cut.
Yes. So
really?
That's what's so interesting here. She was saying, hey, maybe we have Miron, Bullard, and I forget the other one. Oh, sorry, Bowman and someone else dissent. But we know now in the future that they did not dissent, that only Miron dissented. All right. So let's just finish this real quick, and then we'll jump to that idea.
All right, so let's assume we get maybe 25 basis points today from this Fed. What do you think the cadence might be over the coming meetings?
So if we are to see, as Goolsbee warned, Goolsbee, of course, does not vote until January when he rotates in. If we were to see continued upward momentum in claims, if we were to see that line crossed of 2 million in continuing claims, which separates itself from initial because that means that people have been approved to become continuing jobless claimants. If we're to see a continuation, 87% of Texas home builders, 76% of Florida home builders are laying off right now. We saw those single family.
Even the great market at Dallas Fort Worth.
Oh, it's incredible to see how construction has come to a screeching halt, even in Dallas. And we're overbuilt, and a lot of what I call the Airbnb jocks, they can't get financing. Right now, refinancing is really hard, but banks are clamping down on their lending standards. Look what happened with Tricolor last week. So banks are really paranoid about the state of consumer balance sheets. So to the extent that you bought a handful of apartments during the pandemic, thinking that you'd get rising weekly Airbnb rates, VRBO rates on your property, that isn't happening anymore, and that's going to be highly problematic. On top of the fact that baby boomers are also getting nervous, and they've got gigantic homes that millennials don't have enough children to fill. So housing could be a thorn in the Fed side, and including in inflation for some time to be.
We get these lower rates. We know that one rate cut's not going to move the needle. Two, maybe even three if they're quarter point cuts. But if we're going to be in an environment of lower interest rates. Isn't that going to help the housing market?
In theory, it will.
All right, so then go talk about the housing market. So the idea here is that these rate cuts are not going to be enough to do anything. That there's these structural problems in the employment sector and inside the conditions of the economy that make it that what's the Fed going to do? So this is, you think about the long-term trade, we're gearing up for recession, and not just your average recession.
Yeah, I was about to say this doesn't sound like a normal recession.
No,
the problem
this
she
is-
outlined there can't be. How does the Fed rate fix those problems?
They don't.
Okay.
What it does is that it causes the financialization of, or it could inject more liquidity within markets, which then for a while earnings are still up and stuff like that, can cause higher prices and lower bond yields, which is necessary for the refinancing of the debt. That's the whole thing now. Refinance this debt, both government and large market participants, businesses, they need to be able to refinance at lower rates.
Look, what we need are sentient AIs who are going to be buying homes and living in physicalized bodies. This is what we need in robotics, okay? I know everybody's out there, Black Mirror, I don't want the robots to be walking around. I don't only want them to walk around, I want them to buy those houses and to fill them up, because I don't know what's going on there. Anyway, this sounds like, okay, so the next thing we're gonna hear is good news, right?
Well, no. Not good news. So
Right.
what happened is, well, let's just hear the quick sum up from her when she was on CNBC talking about this. So I always like seeing when people are before and after. I like their prediction before, and I like their analysis after. Let's see what she has
All
to
right,
say.
so this is after, this is when? This is the
This
day
is
of?
right after the vote, right after the Fed made its decision.
Let's start with the QI researcher, CEO, and chief strategist Daniel DiMartino Booth. Just your initial thoughts, right? One descends. Myron, he hit the ground running.
He did hit the ground running, but I think it's even
Remember, Stephen Myron is the voting member who still works for Donald Trump. Okay, he still works for Donald Trump and made it to the board and voted for 50 basis point cut. He's the only one who dissented. Just remember that.
more apparent, though, that the other members of the Federal Open Market Committee decided to be a unified front against Myron, because we know that we've seen appreciably weaker job market data, and that we should have seen Michelle Bowman and Waller dissent with him, and yet we didn't. So I think this might have been an us against him type of situation here. I can only imagine how awkward this meeting was.
I'm going to get more later on into the nuances of the palace intrigue, if you will. But let's talk about a dovish 25 basis point cut versus a bearish 25 basis point cut. We know that the markets usually trade much higher, right, when there's a rate cut without recessions and they start, and when there's not. How do we know? How do you determine what's a dovish? JP Morgan said if it was a dovish, we go up. If it was bearish, we go down.
Well, I think the fact that Fed officials do not see inflation coming down anytime soon, according to the dot plot, we'll have to study that in a few minutes, but I think that indicates that this was a hawkish 25 basis point cut.
All right. Speaking of a dot plot, now this is the Bank of America, right? This is what they anticipated here. And sort of to your point, Bowman and Myron, not Myron, Bowman and Waller, you know, just, I don't know. There's some intrigue there, right?
There is real
There's no
intrigue
doubt
there,
about that.
I'm telling you.
Right. So you got Myron down here, but he was down here by himself, right? They didn't anticipate that. So already what people thought was going to be the dot plot isn't the dot plot.
Yep. And I think, you know, there was an open plea for Kevin Hassett a few days ago from his colleagues saying, don't take the position, even if offered the position by President Trump, to replace Jay Powell because you don't want to be seen as a political patsy. I think that the committee today basically said, you didn't actually join our board for more than just a few months. You're going back to your job in the administration, so we're going to stand united as a Federal Open Market Committee against you. Just my thoughts.
So,
ooh, boy, Jerome Powell came out, shots fired. You thinking to take the throne from me? Come at me, bro. That's what Powell is saying. All right, so look, the politics game here matters. They're playing politics while they're trying to say that we're not trying to play politics, and this is with people's lives and livelihoods. So let's just get it out of your heads that the Fed is not like listening to what's going on with the administration and is not trying to do what it needs to do in order to keep its power. Remember, the moment it's seen as consensus that the administration has taken over the direction of what the Fed will do, that's it. That's it. People will no longer listen to the Fed. They're going to listen to Scott Bessent. Scott Bessent will be de facto Treasury chairman of the Federal Reserve. That's just what it is.
All right. What are we going to be hearing later on in the stream?
What we're going to hear later on is just a little bit from Powell at the Fed presser, just a little bit, to touch on what our expectations should be for October and how we might need to prepare for a massive crash when it starts, either later on this year or in March 2026.
I want to hear how this affects different kinds of traders. I don't know what's to trade, intraday, prop firm, et cetera, hodlers. Maybe those are not traders. So can we hear some more about that?
Of course, absolutely. Right after a word from our sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
We'll go. All right, let's get a quick word in here from Jerome Powell. This is from the Fed presser on the 17th.
That's what I meant by that.
Like a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Did you hear that? I don't think I've ever heard that from a Fed chair ever before. Did you hear what he said? The questioner, first of all, asked the question that should have gotten thrown out of that room and never asked another question in his entire life. He said, you make predictions 2 years out, and every 2 years your predictions are wrong. SEP, those are the summary of economic projections. Your projections are always wrong. Why should we believe your projections today if they're wrong all the time? And Powell says
it's because it's projections in quotation marks. That's clearly what he just didn't do the quotation fingers.
Powell said that's the nature of the exercise.
Mm-hmm.
The homework says write down your projection, but no one knows. He said this, no one knows what the economy will be like in 3 years, but we have to write down something. Excuse me. You're the one who's supposed to know what the economy is going to be like in 3 years. That's literally your job. That's what the PhDs are supposed to be doing there. You guys are supposed to be in that building figuring out what the economy is going to be like 3 years from now and making decisions accordingly. He says we don't know. Okay. Fantastic.
Serenity now. Serenity now.
All right. Let's jump to the next one over here. We're talking about the question is going to ask about 50 basis point cut. Why not cut 50?
Under what circumstances would a larger than 25 basis points rate cut be warranted?
Under what circumstances would a larger than 25 basis point cut be warranted?
How seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done.
Okay, so remember, we just heard from Danielle. He's saying this. There was no widespread, discussion about 50 basis points, because this is him going, I got the reins. I got the reins on the FOMC. Barely 50 basis point. Honestly, until you mentioned it right now, I didn't even think about it. Right? That's what he says over there. There's no widespread thing. And he goes on to say later on that the question is like, well, is 25 basis point even enough?
Right.
Like, how are they going to do anything? He's like, the market is already pricing in more cuts in the future.
We don't have
We
to do
forward
anything.
guided it, and the market is already doing that. So why do we need to do it if the market's already doing it? Okay. You want to go take a look at this presser, want to go look at the Q&A. It's not just for wonky people like me. What he says there, if you read between the lines and you see the game that's being played there, what he says holds volumes. And what the market liked is that, hey, we're just playing games here about how much we're going to cut. No one's here is even pretending we're not going to cut. Let's just go ahead. Cuts are coming. It'll be 25 basis points. It'll be 50 basis points. But the question we have as traders is, how can we profit from this information? Well, there are a number of ways, okay? One, we know, as he said in the presser, no one knows what the economy is going to be like 3 years from now. So throw that out of your mind. All the narratives out there, throw that out, all right? That the Fed knows anything more than you do. It doesn't. The economy is, in one way, doing poorly with jobs. So we know that might have some effect on earnings. That means if you buy options, put options, leaps or options further out, you might be able to get lower interest rates, lower premiums on the options further out. So you can have options that you buy right now for, let's say, a year from now that end up paying out 5, 10x, because the odds are not being priced in right now of that recession. Remember, the best time to buy options is when people think you don't need them. You buy options for the downside when markets are all-time highs, because then, generally speaking, what you're paying for those options are cheap. When the market is crashing, then those options cost a lot of money. So any bad news that happens, Peter, continuous claims like Danielle DiMartino Booth was talking about, if they take over 2 million per month, that means it's getting worse. The economy is getting worse as far as layoffs are concerned. Those options will go up in price. If you're buying short-dated bonds, the expectation is that not only is the Fed going to be cutting, but they might have to emergency cut faster. So those bonds might go up dramatically in value if some bad news comes out as the market prices in what's going to happen. Remember, the Fed is saying, the market's already pricing it in. They're doing whatever the market prices in is what the Fed will decide to do. Okay, and so if the market prices in that the Fed needs to cut rates dramatically, that's what they're going to do. So TLT bonds, a 2-year, 5-year, 10-year, these might go up dramatically in value, even if you don't go down to 0% interest rates. But my favorite is the my favorite will be for the trend. All right. So once the trend starts turning and you have now a downtrend in equities, what that will mean for intraday traders is that we might get massive drops intraday or even overnight. So it makes it so that we saw today, what is it, a 70 basis point, 75 basis point move up in the NASDAQ.
Can you show that?
Yeah, if we on the NASDAQ, we had a 75 basis point move. 1 second here. On the NASDAQ, so we had this move up over here.
I don't see your screen.
Sorry, let me just share that. We had a move up from the lows. It was something like about 70 basis point move up in the NASDAQ. All right. Well, if we're in a bear market territory and prices are moving down, they're going to move down quick. They move down hard and sharp. So in a recessionary thing, if there's bad news that pops up, if you start seeing stuff like the jobs numbers getting worse, right? And that should be the expectation that they're going to get worse. That means you could place your bet beforehand. Hey, the jobs numbers are going to come out at 8:30. Chances are they're going to go up pretty dramatically. Get the jobs market moves slower. I would want to short before there, and you can make thousands of dollars on the drop at 8:30 as it happens, or trend that way for the day. So if for people who want to pass prop firm accounts, for people who want to do zero dated options, for people who want to buy dips in crypto, if this bad news keeps getting worse on the jobs front, then you can get massive drawdowns, especially if the expectation is that inflation is not really coming down, so the Fed can't really jump to cut rates a lot. Well, then then the market will drop even further, trying to force the Fed's hand. And then the final thing there is the bet in markets. Right now in Polymarket, let me see if we can pull that up.
Polymarket. Okay, we got 45 minutes in before you are showing us Polymarket. Are you falling out of love with Polymarket?
Well, here the Polymarket is priced in right now an 86% chance that the Fed will cut 25 basis points and a 4% chance that they will cut 50 basis points. All right. That means if you put $100 into that they will cut 50 basis points, it's 22 to 1. You can get paid $2,200 for your $100 bet. Okay. But that means if in between now and that Fed meeting, any bad news comes out for the market, for the employment market, so unemployment ticks up, continuous jobless claims, any information, layoffs, anything like that, then the market will move dramatically. The odds market here might move from 4% to 6%, and you might double your money. You can get 100 to 300% gain, and the market hasn't even settled yet. That could happen next week. So that'll be one of the trades I'm in. You just put money into here. You put some money into not financial advice. Do your own research. You put some money into the 86% chance for something that's more of a surefire thing, and you put some into the 50 basis points. And whenever it goes up, whenever that position doubles in value or triples in value, sell some. Wait till it comes back down. Buy it again, and rinse and repeat, and rinse and repeat, and rinse and repeat. It could be a money-making thing. Peter, understanding macro trends and when those news points come out and how they can move markets on the short term is one of those areas that people really don't focus on, where they can make a lot of money. If you find it difficult to trade day by day, you might find it that this type of trading, where you're a vulture waiting for the lines to kill some animal, and you're going to go eat a little bit of the meat off the carcass, you'd be surprised how much you can profit from there. I didn't mean to describe it that way. I know there's bulls and bears and pigs and alligators and vultures. There's all kinds of animals out there. No judgment. But I know a guy who would all he did was trade one of these reports that would come out. Every month he would trade it. He'd be in the trade for 20 minutes. He put on this big bet. He'd make his money, and he would make 25% of his the value, increase 25% of his portfolio every time. Every month, 20 minutes, trade puts on, leaves, and comes back a month from now. If you can find that edge and that market where you can take advantage of it, you might find that you're better at trading than you think.
And if you are and I've heard this from a few traders, tired of staring at the charts, tired of trading all day, you might be interested in the series for Blueprint that Tom has started about becoming a Pine code developer on platforms like Fiverr. You can make a lot of money. The video that was just released was Tom showed how he made $10,000 a month on Fiverr. That's just coding Pine code and Pine code. Tom, you want to talk about that? Pine script.
Yeah, it's very important to me. I think it's very interesting to realize that there's more ways of making money inside of the retail markets, the trading markets, that don't actually require you trading day by day. right? So some people find prop firms where they're able to trade essentially someone else's money without having to trade their own. Some people love that. Other people have automated strategies that they set up using a software like Traders Post that is taking some input and generating buy and sell signals, whether that's tweets online, whether that's reports being sent out, whether that is buying with certain patterns on the chart. Some people love that. And other people like me find that there's ways of surfacing the retail trading market and making money that way. And in this video, I just showed how I went from making $0 a month to $10,000 a month, making indicators and strategies for other people, because I found that was something I was really good at in markets, and trading myself, not so much. I'm saying $10,000 a month is actually higher than that. Peter's the one who makes me put 10,000. He says it sounds less crazy than the number I wanted to put on there. But hey, to each their own. All right, guys. That's going to be it for After Hours today. Very much appreciate you being here. If you like this, please go ahead and click like or subscribe. Get notified about when we go live, because we're always trying to find ways of giving you information, giving you an edge, giving you a way of interpreting information so that you can trade markets in the way that makes you feel best and make the most amount of money. We're going to be here again next Friday for more After Hours, but we'll also be here Tuesday to Friday every morning, 9:30 a.m. Eastern Standard Time, to trade in front of you using Traders Post, the most advanced trade execution known to man. So click like and subscribe, click that bell, get notified, because you're not going to want to miss any of the videos that we put online. Peter, tell me another platform, another tech SaaS providing tools for retail traders that is as much varied content as we do. You'd be hard-pressed.
Hard-pressed.
Wouldn't be able to find it. All right, anything else you want to say, Peter, before we leave?
No, that's it. If you want to see them trade when the Fed made its announcement, there's actually a price action live that took place on Wednesday, so that's a fun one to go and watch. Didn't go the way they expected.
Yeah, and if you're interested in getting a coupon code, some people's like, I want a coupon code for Traders Post. Yeah, go ahead. Go take a look at Price Action Live. There's a coupon code in there, and you'll be able to get 20% off of your subscription, even add-ons. So even if you're already a user of Traders Post, you can get a 20% discount on add-ons. All right, that's it. We're going to be back next week. Thank you very much. And as always, we wish you guys happy trading.